So one thing we need to talk about before we take it a step further, where we're looking at what the taxable income is going to be, is we need to figure out the filing status. So your filing status, there's lots of different options that you can choose from, but it's based off of your family situation, and it determines the standard deduction and tax liability. So I'm going to go over the different filing statuses. So you will file as single if you're not married, legally separated from your spouse, or divorced on the last day of the year. You'll be married filing jointly if you're married and both you and your spouse agree to file a joint return. So on a joint return, you report your combined income and deduct your combined allowable expenses. You can also be married and file separately. So if you're married and you want to be responsible only for your own tax, or if the status results in less tax than a joint return. So it's rare that filing separately will it'll be less than if you're filing jointly that you'll owe in taxes, but sometimes it is the case, so I always recommend you check both. Head of household with a qualifying person. So your head of household, if you're unmarried or considered unmarried on the last day of the year, you paid more than half the cost of keeping up a home for the year, and you have a qualifying dependent, so like a child, living with you for more than half the year, except temporary absences such as school. And then the last different filing status is a qualifying widow or widower with a dependent child. So this status is available for 2 years following the death of your spouse. So let's look at an example now. Maria earned wages of $32,400 from her job as a server. She also earned $8,300 in tips and received $95 in interest from a savings account. In trying to save for retirement, Maria has put $3,500 into a 401k tax-deferred savings plan. She's unmarried and lives with her 6-year-old daughter. Determine Maria's gross income, adjusted gross income, and taxable income. So in this case, the first thing that we're going to do is we will find her gross income. So again, for finding that gross income, and we're going to go and use that filing status in a minute for the standard deduction. But let's first go through and calculate her gross income. So her gross income, again, gross income is adding up all of what you've earned. So she earned $32,400 from her job as a server. And then she also got $8,300 in tips and $95 from her savings account. So when you add all of that up, her total earnings, her gross income, is $40,795. To find her adjusted gross income, we're going to take that gross income value, so that $40,795, and we're going to subtract any adjustments. So it looks like her adjustment is going to be putting $3,500 into a tax-deferred savings plan. So again, that tax-deferred means she's not owing any interest or any taxes on that amount that she's putting in there at the moment. So that's going to be $3,500. So when we do that, we get her adjusted gross income is $37,295. Now, to calculate her taxable income, we take this adjusted gross income and we're going to subtract any deductions. So it's going to be either she takes the standard or she takes the itemized. So in this case, if they haven't talked about itemized in the situation, we're going to assume that she's taking the standard deduction. So her taxable income, so that comes from, so we're going to take her adjusted gross income. Oh, and it looks like I forgot to write that value in there. So her taxable income is going to be taking her adjusted gross income, so $37,295, and then we're going to subtract her deduction. So I need to figure out what her filing status is to figure out what her deduction is. So she is unmarried and lives with a 6-year-old daughter. So she's unmarried and she has a dependent. So that puts her into the head of household qualifications. So instead of being just single, where you can only deduct $12,950, because she has a child as a dependent, she's able to do the head of household and actually deduct $18,000. So this is why it's important to know which one of these filing statuses that you fall in, because sometimes you can save more money. So we get to subtract $18,000 from that, which leaves her with the only income that can be taxed is $19,295 out of that total $40,795. Okay, so now that we found her taxable income, so we found that Maria's taxable income was $19,295. The next thing we need to do is figure out her taxable, what she ends up owing for taxes. And that'll be, again, before we take off any credits or withholding that she's already paid. So what we're going to do is we need to figure out where she falls in the tax brackets. So you're going to see there's different tax brackets, and I have them all available on these slides. So you're just going to kind of follow the slides, and you can use these to help. And these are for 2022, so this would be helpful for you as well for figuring out taxes for this year. And then they change a little bit from year to year. So if this year ends up being later than 2022, you'll be able to see the later ones. So okay, so let's see. So she had $19,295. So where does that put her? It looks like that is going to make her fall in this category, the 12% tax rate. Now, just because someone falls higher in the tax rate doesn't mean that they're paying 12% on the total amount that they got. So what happens is the way that taxable income works is that you end up getting, so for the first $14,651, she's just going to be paying 10% on that. And that's what this value is here. 10% of $14,650 is 10%. And then she'll owe 12% just on what is above that. So tax brackets, you're not paying, again, you're not paying that, like, for example, if you fell within here, which would be awesome, you're not paying 32% on that entire amount. You're going to pay 10% on the first $14,650, 12% up from the next amount up to $55,900, 22% for what's left with $89,000. So again, it's only what you're making over that extra amount. Okay, so that was a lot of information. So let's go back and figure out what Maria owes in taxes. So she falls in this 12% bracket. So to figure out what she owes in taxes, so owe in taxes. Okay, so we're going to take $14,165 and we're going to add 12%, so 0.12 is that 12% of always means multiplication, the amount over $14,650. So the amount over that she made, well, we can figure that out by taking what she did make and subtracting $14,650 from it. So that's what she has made. This amount is what she'll have made over $14,650. So when we add all of these up, we end up getting that she owes $2,022.40. Let's do a few more of these. Sierra is filing single and has a taxable income of $45,000. Calculate what Sierra owes in taxes. So here's the single tax bracket. So you notice this is different than the head of household tax bracket that we used for Maria. So your tax bracket, just like your standard deductions, are different based on how you're filing your taxes. So her income of $45,000 is going to put her right here in between $41,776 and $89,075. So let's figure out what she's going to owe. So we know she falls into that, so we're going to use this formula. So her taxes owed. All right, so it's going to be $4,807.50 plus 22% of the amount over $41,775 or $75. So 22% is 0.22 of means times the amount over $41,775. So to figure that amount, we'll take what she made, $45,000, and subtract $41,775 from that. And this total, when I subtract these, this difference is going to be the amount that she made over $41,775. So when we put that in to a calculator, we end up getting $5,516.50. All right, so now let's look at if you're married and filing jointly. So here is the married and filing jointly tax bracket for 2022. So Tina and Amir are married and filing jointly. Their taxable income is $132,500. Use the tax bracket below to calculate their taxes. Okay, so they make a total of $132,000 or $132,500 of taxable income. So that's going to fall right in this category here. $132,500 is between $83,551 and $178,150. So their taxes owed are going to be, let's follow this formula. So $9,615 plus 22%, so 0.22 of multiplication, the amount over $83,550. So that's going to be taking what they made and subtracting $83,550. And when I do that, I get $20,384. So the taxes that they're going to owe are $28,384.